Welcome to The Explainer. Today, we're diving into insider trading on decentralized exchanges. And look, this isn't just some dry, boring finance issue. We're talking about a full-on modern digital procedural. We're going to unpack exactly how these pseudonymous financial crimes are pulled off on the blockchain, and honestly, the really exciting part, how digital detectives are finally catching up. We'll be looking at how the convergence of on-chain data and off-chain analytics is completely reshaping crypto market integrity. Okay, 56%. When Solidus Labs dug into 234 ERC20 token listing announcements, they found that a massive 56% of those reviewed listings showed distinct indicators of insider trading. 56%. Just let that sink in for a second. That means more than half the time a token was listed, somebody out there likely had confidential knowledge and used it to front-run the market. It completely shatters this illusion we have that crypto markets are somehow immune to the oldest tricks in traditional finance, right? And we are definitely not just talking about a couple of lucky traders here. Solidus identified 411 suspected trading events, and they were all linked back to just 105 individual wallets, or connected groups of wallets. To put that into perspective, this is a multi-billion-dollar systemic vulnerability that demands our attention right now. What we're seeing here is serial, highly coordinated behavior. When you see the exact same groups of connected wallets popping up around multiple different listing events, yeah, that's not a coincidence. That is a highly organized effort to extract wealth using inside information.
So where is all this going down? The scene of the crime is the Decentralized Exchange, or DEX. Now, the architecture of a DEX is this brilliant double-edged sword. On one hand, you get amazing accessibility and transparency, because every trade is right there on a public ledger for everyone to see. But on the other hand, it's literally the perfect playground for pseudonymous misconduct. It's kind of like a massive bank vault where everyone gets to wear an invisible mask. A trader can just spin up a bunch of wallets, trade a token right before an announcement drops, and cash out, all without ever using their real name or relying on a central operator. Let's walk through the actual anatomy of one of these digital heists. It basically follows a four-step playbook. Step 1, a bad actor gets their hands on non-public info. Maybe they're an exchange employee, an advisor, or even part of a PR agency prepping the listing announcement. Step 2, they use that secret knowledge to go buy the token on a DEX where it's already trading. Step 3, and this is a crucial one, they route their funds through intermediary addresses or bridges to hide the true size of their bag. And finally, Step 4, the announcement goes live, the price pumps, and they dump their tokens into all that new demand. It's a calculated, ruthless extraction of profit. Which brings us to a really huge question. If this playbook is so well defined, why in the world do legacy surveillance systems completely miss it? Seriously, why are these traditional, massively funded financial safeguards totally blind to this specific type of heist? It's a vital question, and the answer really comes down to a clash of architectures. It's about how those legacy systems were built versus where this new activity is actually happening. Think about traditional trade surveillance. It was built for a legacy world, right? Identifiable accounts, centralized order books, heavily regulated venues where the institution absolutely knows the customer. But DEXs operate in a totally different reality. The getaways happen because trading is executed through cross-chain pseudonymous smart contracts. So a centralized exchange might be monitoring its own platform, and they see the final sale after the announcement, but they completely miss the sneaky pseudonymous purchase that happened over on the DEX days earlier. The legacy systems are just outmaneuvered. But don't worry, the digital detectives have a new toolkit, and it all revolves around one major forensic breakthrough: convergence. Platforms out there, like Solidus Labs' Halo system, were designed specifically to solve this exact mystery by connecting the dots. They realized pretty quickly that you can't catch a DEX insider trader just by looking at the blockchain, and you definitely can't catch them just by looking at HR files. You have to combine them. You have to converge the data. To see how investigators actually cross that boundary, you have to connect two completely different data sets. On the public side, you've got on-chain data. That's your swap timing, liquidity pool movements, the raw wallet behavior. But over on the private side, you've got off-chain, human data, stuff like listing announcements, publication times, internal employee access logs. By taking that public blockchain ledger and layering it perfectly over a confidential corporate calendar, investigators suddenly get the whole picture. The blockchain tells you what happened, sure, but that off-chain data, that tells you why. And this is exactly how they unmask the network. It goes way beyond just looking up a single suspicious trade. It's deep behavioral analysis. They look at trade timing and profit, obviously, but they're also hunting for shared funding sources, like are multiple wallets being funded by the exact same starting address. They use wallet clustering to map out these coordinated groups, but the real kicker? repeat behavior. If a cluster of wallets repeatedly scoops up tokens right before multiple, totally unrelated confidential listings and then dumps them right after, boom, that is the smoking gun. It entirely destroys the whole "I just got lucky" defense. No way. Now hold on a second. Before we start yelling insider trading at every single weird trade we see, we need to look at our suspect lineup. This is where we get into the nuanced taxonomy of market abuse. Categorizing every unfair on-chain trade as insider trading is a huge mistake. A truly resilient surveillance program needs totally separate rules and playbooks. Because while other behaviors are definitely sketchy and disadvantage users, their actual evidential foundations are completely different. Take maximal extractable value, or MEV, for example. This is when validators, or these specialized searchers, actually influence the ordering of transactions inside a block to capture value. A classic example is a sandwich strategy, where they squeeze their trades right before and right after yours to siphon off the price movement. It's incredibly frustrating, absolutely, but that is structural blockchain manipulation. It's not someone exploiting confidential corporate information. Then you have front-running. This is when someone spots a pending transaction just sitting in the public mempool, which, remember, anyone can see, and they quickly submit their own transaction with a higher fee so the network processes theirs first. Again, this is someone exploiting the public transaction queues of the blockchain's architecture. It is fundamentally different from someone secretly knowing a token is about to get listed on a major exchange. And lastly, wash trading. This tactic is all about creating fake activity. It's when a single actor executes transactions between accounts that they actually control, all just to pump up volume and create false market signals. So that rounds out our suspect lineup. These are all unfair, distinctly different on-chain tactics that mess with the market. But we have to keep them separate from insider dealing, which, at its core, always requires material, non-public information. Okay, let's shift gears a bit, because regulators around the world are absolutely waking up to these distinctions, and honestly, they are bringing the hammer down. We are officially entering the era of the new regulatory playbook. Crypto market surveillance? Yep, it's no longer just a voluntary, nice-to-have risk management feature for exchanges. It is rapidly becoming a strict, legally mandated regulatory requirement. And this global clampdown is already in full swing across multiple jurisdictions. In the US, prosecutors aren't messing around. They're hitting people with wire fraud offenses. There was a landmark Coinbase case where a former employee tipped off his brother and a friend, and that case definitively proved that hiding behind pseudonymous wallets will absolutely not protect you from wire fraud charges if authorities can connect the dots. Over in the EU, they've rolled out the MiCA framework, which explicitly requires firms to prevent, detect, and report market abuse. And the UK just finalized a dedicated crypto market abuse regime demanding on-chain monitoring. The net is definitely closing fast. To survive in this new, heavily scrutinized environment, institutions have to urgently build what we call a resilient control stack, and it requires 6 essential layers. You need strict information governance. You have to know exactly who sees what. You need employee surveillance that actually covers personal, self-hosted wallets. You must have event-based analytics tying specific trades to announcements. You need cross-market coverage so you don't have massive blind spots between centralized and decentralized venues. You need wallet clustering to uncover hidden networks. And finally, typology-specific detection, so you aren't confusing a wash trade with an insider deal. But amidst all this tech, there's a crucial point we have to remember from the research. As the quote goes, technology can identify the pattern. Human investigators still need to establish materiality, knowledge, legal duty, intent, and the appropriate regulatory response. An algorithmic alert is not proof of a crime. To make defensible decisions, you still desperately need experienced human review to take that on-chain pattern and actually prove the off-chain legal intent. The humans are absolutely still in the loop. Which brings us to one final, really provocative thought to leave you with. People love to call crypto opaque because of all the pseudonymous wallets. But think about this for a second. Every single swap, every transfer, every smart contract interaction, it is permanently recorded on a public ledger. Investigators can go back and analyze it retrospectively, literally forever. So will the radical transparency of the blockchain ultimately become its greatest defense against financial crime? It's a fascinating paradigm shift, right? Proving that the very technology used to commit the heist might just turn out to be the ultimate tool to catch the thieves. Thanks for joining me on this explainer, and keep questioning the data.